Thanks everyone for joining us today. My name is Lucas Nuzzi. I am the head of network data at Coinmetrics. And today I'll be talking about Bitcoin's monetary fairness and its significance in light of recent events. So we'll be showcasing some data to support this idea that Bitcoin is the most fair monetary system in existence, and why this is very relevant today, given everything that's happening in the world, and why it's particularly relevant when we talk about money. So, as we know, the response by central banks to the coronavirus pandemic has created a lot of money paradoxes. On the one hand, there is widespread concern about central bank interventionism and markets not really reflecting reality whatsoever. And on the other hand, there is increased demand for US dollars, right? The demand for dollars remains incredibly strong around the world. And here on the left side of the slide, you can see an overlay of quantitative easing programs, which is basically when the government prints money to buy its own debt. And the fourth iteration of the program that's highlighted here in red, as you can see, has been much more aggressive than previous iterations. And some estimate that the Fed's balance sheet this year might end up reaching $11 trillion by end of year. And since it's a global crisis, demand for US dollar actually increased in spite of these concerns with sovereignty. And even our industry has been impacted by the rise of stablecoins, with stablecoins nearly doubling over the past few months and almost reaching $12 billion. And on paper, this was the perfect storm for gold, right? And gold bugs initially felt vindicated because gold was appreciating relative to the global markets in the early stages of the pandemic. But gold itself fell prey to the global supply chain issues that the pandemic introduced. So here on the left, you can see in blue outstanding gold warrants, which are electronic documents that need to be issued before gold is physically delivered. And as you can see, there were millions of ounces of gold that, because of these supply chain issues, simply could not be delivered. And this ended up creating pricing issues. The spread between spot gold and futures almost reached a new record, as people who wanted gold couldn't have access to gold. And people who thought they owned gold, they also realized that they're at the mercy of these third parties that are subject to other issues that you'd face in the pandemic, right? And meanwhile, Bitcoin was operating business as usual. In April alone, it settled the equivalent of $50 billion. So in an era of pandemics and social unrest, it's pretty clear that a reliable store of value needs to be portable and digital. And remarkably, while central banks around the world were expanding quantitative easing programs and printing trillions of dollars to support markets, us Bitcoiners were celebrating the predictability of Bitcoin's monetary policy ahead of the halving, right? So as you can see here on the left, we have the annual sum of Bitcoins produced through mining, and the black line shows the year-on-year change in production. As you can see, Bitcoin's mine production has been decreasing aggressively over the past decade. Whereas if you look at gold here on the right, mine production is actually expanding since countries like China, Australia, and Russia are boosting production. In fact, this year will be the first year where Bitcoin supply inflation is lower than gold. So, okay, so thus far we've established that Bitcoin is portable, it's digital, it has an algorithmic monetary policy. And one might say that this is also true for several other crypto assets, right? Especially the forks of Bitcoin. But what makes Bitcoin unique as a monetary system, a fair monetary system, is the fact that as the first successful crypto assets, there were basically no guarantees or precedents that signal that it was going to succeed, right? So here we have in purple the 1-year active supply velocity, which can be characterized as the rate of asset turnover. So basically a ratio that shows how many times the very same unit of Bitcoin changed hands. And this sinusoidal pattern that you see here is a good representation of the ups and downs that Bitcoin experienced in its turbulent history. So there are no guarantees of its success, and some of these events, like the rise and fall of the Silk Road, the big block wars, ultimately increased asset turnover and led to a much more distributed monetary base, because these early adopters that went through those first booms and busts of both activity and in the market sold coins to newcomers because there were no guarantees of success, right? And there was plenty of FUD. And these newcomers then became early adopters, and then that cycle has undoubtedly democratized Bitcoin's monetary base. And that fairness, if we try to quantify that democratization and decentralization in numbers, it's really clear when we compare Bitcoin to other crypto assets. So here on the left, we have the number of addresses holding more than 1% of total supply across several crypto assets. We have Bitcoin Dash, CCR, Bitcoin is right there on the bottom. And as you can see, while other networks became more centralized over time, Bitcoin in the bottom of the chart has consistently become more decentralized over the years. And the table here on the right shows the year-on-year change in addresses holding more than 1% of the supply. So here you can see, relative to 3 years ago, the number of addresses that hold more than 1% of Bitcoin's supply has gone down by 33%. And over the years, Bitcoin has consistently decentralized its monetary base, whereas assets like Ripple, Stellar, and even Zcash have consistently become more centralized over the years. And another reassuring data point is that in spite of this decentralization of the monetary base, the case for Bitcoin as a store of value is still growing pretty strong, and it can now be supported by data. And this contradicts analysts that think, or like to think, that ownership centralization is some sort of indicator that the asset is becoming more of a store of value. Right here we have an indicator called the hodl factor for Bitcoin specifically, which can be characterized as a direct measure of the store of value narrative. And it's calculated by looking at the supply that was ever active in a network, supply that left that Coinbase address, minus the supply that was active, in this case here in the red line, the supply active in 1 year, divided by the total supply of the protocol. And for the first time in Bitcoin's history, the 1 year hodl factor surpassed 50%. And that means half of Bitcoin's active supply has not moved in 1 year. And this was an insight by Coinmetrics' Ben Sellermayer, and it's a very important indicator of a long-term holder base that really supports this store of value narrative. So really interesting to see all of these things converge at the same time. And to conclude, the 2020s might be the decade that we see hyper-Bitcoinization. Everything that we've experienced up until this point has solidified the value proposition of Bitcoin. Its fair distribution and turbulent history have created this truly decentralized and stateless monetary base. And stateless here, beyond just a nation state, not a foundation, not a development arm, not a development company, not a company, right? A truly stateless monetary base that strengthens the case for Bitcoin as a store of value, which now can be supported by data, and really solidify this idea that Bitcoin is the antithesis of interventionalism and the type of money that we will need heading into the 2020s. So this is the data that I want to showcase with you guys today. I think we have some time for questions, if there are any at this point.
There haven't been any questions yet. Jan, do you want to go ahead and do your presentation? Yeah, absolutely.
There's only at the end, then we'll add.
So we also looked into some potential trends that were happening over time and tried to use data to really quantify them and kind of solidify how we think or kind of why we think Bitcoin is really well positioned right now to kind of benefit from the macro environment. So just for some background, some of the initial stats we looked at were just the general wealth distribution of the supply, and so this is based on Bitcoin supply by address size, and so you can see it started to really normalize around 2013, and then you start to see the kind of adoption on the lower end. So this is an example of the previous chart, but in a tabular view, and as expected, the wallets holding. So this is the percentage of the overall supply broken out by individual wallet size. So as expected, the wallets holding 0.001 to 0.1 or to 0.01, 0.01 to 0.1, and then 0.1 to 1. Those are all kind of gradually increasing, and that makes sense as a lot of new users come in and the smaller holders kind of increase in size. But then the one trend that was really noticeable for us was the increase in holders of 1,000 to 10,000 bucket, which kind of goes against the initial logic that you're starting to see a larger individual holder base. But one of the reasons we thought that was happening is because there's growth in exchanges and the amount of coins held on exchange. So the other way we kind of broke that out, besides just by percentage of the supply in a specific wallet size, we also broke out the quantity of wallets in each individual one. And so again, you kind of see that growth in wallets and all the smaller size wallets. But the one interesting trend that we kind of noticed here as well was the growth in the quantity of wallets holding 1,000 to 10,000 Bitcoin. And so some of the likely causes that would make sense for this are Bitcoin moving to exchanges, Bitcoin moving to custody solutions, and a third one being there's potential accumulation by whales. So to kind of go through these and really try and figure out what the potential cause might be, we started looking into all the various factors. And so the large jump in coins on exchange at the end of 2018, the amount that in that 9 window, the amount of Bitcoin on exchanges increased by 850,000. The amount of Bitcoin in wallets holding 1 to 10,000 Bitcoin has increased by 850,000, and then at the same time, the amount on exchanges jumped by 825,000. So that kind of serves as a decent proxy to understand that a lot of the coins in that wallet size, or a decent amount, could be on exchange coins. So then to think about where exchanges are today, and so there's been the same amount of Bitcoin sitting on exchanges today as there was in the beginning of 2019, where at the same time the amount of Bitcoin in wallets holding 1 to 10,000 has gone up by over 500,000 Bitcoin, and the amount of those wallets is also up by 250, and putting us over 2,000. So while Bitcoin on exchanges has been relatively flat over that time, those wallets have seen a huge increase. So that kind of means that it might not necessarily just be the fact that it's going on exchanges, because you're seeing that number to stay flat. So then the other situation is potential accumulation in custody solutions. And so one way to kind of track that, you can track the amount of Bitcoin on individual multi-sigs, and you can kind of assume that a lot of the institutional custody solutions are multi-sig addresses just based on the increased security. And so because you can track those addresses, we're able to track those, and over time, or in that window, you didn't really see a material amount of accumulation by those custody solutions. So again, it's not necessarily that it's going to exchanges, and it's not really going into custody solutions. So then the third one being potential accumulation by whales. And so kind of the way we think of that is if you look at the red bubbles denote situations where price rises and the quantity of whales increases, and in here we're just tracking it as wallets and entities with over 1,000 Bitcoin. So you can see these cycles where as Bitcoin price picks up, those whales unload, and you kind of see the the amount of wallets holding at least 1,000 Bitcoin decrease. Then as price declines, the quantity picks up again. And then you saw it in the most recent cycle as well, where the quantity of wallets holding at least 1,000 Bitcoin has started to decrease as price really picked up. And then as price sold off, we again saw that start to pick up. And now we're kind of seeing that phase take place again, which kind of helps confirm that our idea that we think whales are starting to accumulate again. And so although the growth in the number of wallets in the 1K to 10K group primarily took place in 2019, and so you're saying that the quantity of those wallets has remained relatively flat, the quantity of coins in those wallets has continued to increase. So while you're still seeing those whales, it's not necessarily that there are new whales coming into play, but that those existing wallets are continuing to accumulate just based on the amount of supply that's being held in those wallets. And at the same time, if you think about a way to kind of back into, because realistically, it's really hard to narrow down exactly what's happening. It's a lot easier to think of what else it could be going to and eliminate why it's not that. So going back to that logic, if you're assuming that if you're stating that the amount of those wallets is flat, but the quantity of Bitcoin in those wallets is increasing, then one reason could be that it is going to those exchange wallets. But over that time, when those wallets held more and more Bitcoin, the amount of Bitcoin on exchanges has also declined. So huge, like continuous growth in the quantity of coins in the 1,000 to 10K group, but at the same time, Bitcoin on exchanges has seen some of its largest decline. So it's kind of continues to support our idea that we think whales are accumulating. And then just kind of taking a look at the entire holder base. And so this is an analysis we've used before to understand long-term trends and kind of helped us understand why we thought the bottom was happening in the beginning of 2019. And all it does is kind of the logic behind it is understanding when you kind of see long-term holders, when you'll start to see seller exhaustion from long-term holders. So as the quantity in a certain band begins to flatten out, you can kind of see like the selling velocity decrease. And so what we're looking at now is that the overall holder base is actually in a very similar position as it was in the previous halving, where the amount of Bitcoin that's been moved in the past year is at 42 or 41% now, 42% before. And that value usually oscillates between 40 and 60 in between cycles, where at price peaks, it's at its lowest point because you start to see a lot of selling. So you'll see a lot more Bitcoin that's been moved recently. And then as price declines, Bitcoin gets hodled basically, and you'll see the amount that's moved at least the amount that hasn't been moved in a year increase. And so we're in a position now where you're seeing over about 28% of supply hasn't moved in 3 years, and 59% hasn't moved in 1 year. And so that kind of shows us that we're in a great position where a lot of individual holders are holding basically, and a lot less and less. There's a lot less liquid supply really available to be purchased. So you're starting to see a lot less of the market, or the entire market is priced on a lot less Bitcoin that's actually circulating around. And part of that can also be just based on the overall growth in the derivatives market. And then another interesting thing we've seen is kind of a way to quantify weak hands. And so the way we track that is we can look at the 90-day Z-score volatility, and that's a volatility Z-score, and that's a way to kind of normalize volatility over time and understand price moves without really having to quantify the exact price difference. And so we track that relative to increases in liquid supply. And liquid supply we measure as the percentage of supply that hasn't been moved, that's been moved in the past 3 months. And so the thought process being there is when you do have a lot of weak hands, volatility tends to really cause a large increase in liquid supply, because you'll see people sell or people, whether it is from an increase or a decrease, weaker hands will sell on price pumps if they're just trying to cash in, don't necessarily think that there's a lot more value accrual to be had, or on the way down, people get scared. And so the way we kind of track that is comparing that volatility versus the changes in liquid supply. And so you've seen, dating back to 2017, whenever we start to see these huge volatility spikes, we're also seeing a diminished increase in liquid supply. And so that's kind of indicative of why we think strong hands, or we can't, there's a lot of exhaustion from weak hands. And so we're in a really unique position where a lot of the holder base is kind of holding. We're seeing overall decrease in supply on exchanges. You're seeing whale accumulation, and you're also seeing the dissipation of weak hands as liquid supply increases less and less for various volatility spikes. And we kind of think that that's putting Bitcoin in a really unique position to take advantage of the macro environment, and kind of starting to see that realize and take place. And that's also just buoyed by endorsements and kind of conviction from some of the traditional investment managers like Paul Tudor Jones kind of coming out recently as well.
Been a while.
It has been. How's it going?
Yeah, I'm good, man. How are you? How's New York?
Good. It was quiet up until about a week ago.
Yeah, a little bit crazy now.
Yeah.
Listen, great session, guys. We've got a few questions from people coming in now, and I encourage, please throw some more questions in, because we've got about 15 minutes, I think, here to get through them. I'm just going to throw one in before everyone else does. Some very interesting and quite detailed analysis. I assume you both also read the Goldman Sachs recent analysis. Both of you are doing something very different from them in terms of looking and how you look at Bitcoin. What do you think they missed, big picture wise? Start with you, Jan.
Sure. What they missed, it might just be a function of them not necessarily taking a deeper dive, so they kind of miss most of it, in the sense that it kind of seems like their criticisms have been the same ones that have been recycled from past years. And so it's not that they really looked at it and missed. I just feel like they just haven't really given it a serious look at all, and it is tough to assume that they haven't done any due diligence. So it's kind of either that they've missed it, or that there is some kind of inherent desire to not really share what they believe, because their analysis really seemed lackluster and topical.
Yeah, I agree. I think it was interesting to see the juxtaposition of gold and Bitcoin in that report. They were talking about gold not being a good hedge against a scenario like COVID. And then right next to the following slide was just a slide on Bitcoin. So at least they're not brushing it off entirely. But I agree with Jan. Like there's no data that really showcased the true value proposition of Bitcoin. The fact that it's settled over the past 4 years, values in the same order of magnitude as MasterCard and Visa credit cards in the United States. It's something that, if you look at the volume of Bitcoin being actually traded peer-to-peer in countries like Venezuela, has been going up dramatically. So in their very limited view of the world, they completely missed all of these different noteworthy data points that they could at least showcase. So it was a little disappointing. But did we expect anything else? Like, was that a surprise?
No, I don't think so. Well, I don't know. I think they baited us. I think when they announced that the call was coming, I think a lot of people were kind of excited to see, because they put it alongside gold. So, but I think we were baited. Anyway, we've got some great questions coming in. First one in from Aaron Bailey. Is there any data directly from exchanges that can tell us how many accounts own less than 1% of Bitcoins, or can give us a more accurate look at how the Bitcoin user base has gone up?
So I can start. So there isn't data that's being reported directly from exchanges, but part of our efforts, part of Coinmetrics' work, is to tag these exchanges and identify them, and basically analyze their custody and look at how many accounts have they created. And it's difficult to generalize exchange custody, just because a lot of these exchanges follow very different policies. Like an exchange like Binance, they have one address, it's a Binance address. They have another set of addresses for their insurance fund and their cold wallet, but it's a very simplistic custodian workflow, so we can actually see the addresses and the activity around those addresses. Other exchanges is a little bit more difficult to actually separate that by user, because there are exchanges like Coinbase that never reuse the same address. So they constantly generate new addresses, which kind of pollutes the network with all of these UTXOs with small deposits in them. But it's interesting to see that overall, if we aggregate exchanges that have just one address, and like Binance, and exchanges that have tons of addresses, we have like millions of addresses of Coinbase, the balances on both of them is trending down, actually. So, which might be a reassuring data point if you think about self-custody now being a thing. Right? Relative to 2016, we didn't have HSMs, we didn't have ledgers, cold cards. Now it's easy enough for you to take care of your own keys, and hopefully events like people that hold gold not being able to get that gold highlight the importance of not trusting third parties.
Okay, we've got a question from Alex Thorne, Mr. Intangible Coins. On-chain analysis for wealth distribution has limitations due to the use of omnibus wallets at custodians like exchanges. Have you conducted any surveys of exchanges and custodians to understand the distribution of wealth amongst their users?
No, I think it's yeah, go ahead.
Yeah, I think again, it's really difficult to look at the.
Oh, you're gonna have to jump in, Jan, now.
Sure.
Oh, there we go.
Oh, am I back?
You're back.
Yeah.
Sorry, I was just saying that it's difficult to look at one address that holds a bunch of Bitcoin and say, hey, this is user A, B, and C, right? So I think Alex highlighted that it's difficult to make assessments on ownership by looking at the exchange balances. But it's good to see that exchange balances overall, if you have a considerable portion of Bitcoin, you might be doing self-custody, you might be storing it yourself, and that kind of confirms if you look at data on exchange ownership, which has been going down.
Okay, we've got a question coming in from Aaron Bailey saying, can either of you speak to the custodial structure for different exchanges? For example, does Coinbase limit it to 10,000 Bitcoins per wallet, or is it 100,000? Are you aware of anything like that?
I am, yeah. So there's a difference in custodial workflows that's really clear when you look at the network. So Zappa, for example, was in 2016, as they were serving South American countries, they had a very strict way of generating new addresses, and they didn't reuse addresses. They were really diligent about that. And they ended up having a bunch of UTXOs, right, that every single person running a full node has to store. And they worked with Bitcoin Optech to aggregate all of these UTXOs and basically do a cleanup of the network, right? Other exchanges and few exchanges that don't reuse addresses, and there are a few that don't, they have not done that. I think Coinbase is a main offender here, given that they haven't gone through this process of cleaning up all of their outstanding UTXOs. But it's one of those trade-offs, right? On the one hand, it's not good for you to reuse addresses. It's bad for your privacy. It's bad for the privacy of your users if you as an exchange is reusing addresses. But if you're a custodian like Coinbase and you're regenerating addresses for every deposit, and there's no indication that there's any sort of limit to that, because they have a schedule of regenerating addresses that's pretty much on a daily. It ends up creating all of this kind of data that everyone has to store, and it's sort of a spam attack in the network. So there are trade-offs to be considered, but the majority of them reuse addresses. So it's not a widespread problem just yet.
From Harry Suddock, how will Bitcoin function without dark pool capabilities? Will price move, especially based on large wallet movements?
Yeah, I guess it also, you then have to start qualifying the nature of the move. And so whether it's to an exchange or, and I think you'll end up trying to piece together what you think, where you think the Bitcoin is going, to understand what's going to be the pressure there. And so you've seen it now with a lot of data providers that will have triggered alerts for Bitcoin moving to certain walls or to exchanges. And so it depends, but I think we've been able to kind of get away with it for now, where as Bitcoin price increases, you'll kind of expect the quantity of Bitcoin in these individual moves to start going down. So in that respect, I think, if it is going to exchange, I think there could be selling pressure there. But realistically, since a lot of the trading is done just digitally on the exchange and not necessarily on chain, it won't really affect it as much.
Yeah, I would just add that Liquid operates as a great pool, like dark pool. You can just exchange assets on Liquid and use confidential transactions to preserve your privacy. So I don't think dark pools are going anywhere. It's just creating liquidity into those dark pools, which is still kind of early because there's not a lot of infrastructure built around things like Liquid, but I think it's really just a matter of time.
All right. Fred Marion wants to ask about Milkshake Theory. Do either of you know what Milkshake Theory is?
Yeah, the dollar milkshake theory, that basically the dollar will suck up all liquidity. I mean, it's certainly, so the idea is that as the dollar gets stronger, it'll kind of eat away at all the other smaller currencies, just based on the fact that everyone is in an environment where banks are issuing or continuing to kind of devalue their currency, and so you do have this kind of concern that the dollar will really get stronger before it kind of gets weaker, because it'll just eat up everyone else's currency, as a lot of these other countries have dollar denominated debt, and they're kind of then forced to issue more currency to kind of pay off their dollar denominated debt, and then that kind of creates this vicious cycle. So I do expect there to be deflation first because of that, and so you'll see the demand for the dollar outpace basically any kind of issuance that would previously lead to inflation. And then after that, there would be an environment where as costs go up, you'll have inflation driven by like cost push inflation basically. And so that would be more so the driver for inflation in the future. But I am a subscriber of the dollar milkshake theory.
All right. Christian Satori would like to understand the effect of BTC Wealth Whales distribution amongst many smaller wallets.
Yeah, that's definitely something that would cloud the ability of this analysis, and oftentimes for reasons like that, it's often easier to, rather than like testing if something is true, it's testing whether or not all the other alternatives are false, basically. So that's kind of the logic we applied here. But yeah, the short answer is it definitely muddies this analysis, and you have to assume that there are definitely a subset of whales that distribute across multiple wallets just for security reasons, and there's a whole host of reasons to not concentrate your ownership in one wallet.
And Jesus Crypto Plaza would like to know what you think about the Satoshi era of BTC movement. Could it be a security break?
I don't think so. I think that specific balance was not even associated with Satoshi. If you look at Sergio Lerner's research on Satoshi coins, they follow a specific pattern. They have an extra nonce that is identifiable, and that was not part of those coins. So it is incredibly rare for a coin that early on to be transacted, but there's no indication that it could be part of Satoshi's balance.
All right, one final question, I think, is this probably a good one for both of you, from Aldin Adamovic. I'm sorry, I've pronounced that probably incredibly wrong. We're seeing volume from DEXs increasing massively for ETH and other altcoins. When will Bitcoin have a native DEX with enough liquidity?
Native, I think never. I think we've tried that with Counterfactual and other projects in Omni and all these quasi layer 2 solutions. It was never something deemed safe enough to be at Bitcoin's base layer. And we have sidechains for that. We have Liquid for something like that. Of course, it's different, right? It's a different model, but there are trade-offs between security and decentralization, right, and functionality. So I think Bitcoin, as of right now, as it's kind of strengthening this store of value narrative, it would be a little reckless and basically impossible for it to host a DEX at the base layer. But it could through sidechains and bridges to other networks.
All right, fantastic.
Yeah. No, I'm definitely in a similar boat where the issues are right now as people try and bring Bitcoin to other exchanges. It's through peg mechanisms that have a lot of issues in terms of how security scales with the amount of assets that are being secured, and the incentives aren't really aligned to help that scale appropriately. So I think you'll have, and there's some being built out now that we don't have to necessarily go into, but the idea is that you'll have like cross-chain solutions that won't make a certain coin leave its own chain or kind of create like a pegged asset or anything like that, but it's more so communicating across the chains. And so I think those types of developments will kind of happen. So you'll have some kind of cross-chain exchanges, but it won't necessarily be that you'll have a wrapped Bitcoin or a kind of a pegged asset that's issued on a separate exchange that is collateralized by Bitcoin, but rather Bitcoin sitting on an exchange and then having these two assets kind of communicate through some kind of a model that incentivizes proper communication for the amount of assets that are scaled on the network.
All right, Jan, Lucas, thank you so much. Hopefully I'll get to see you in person soon. Hopefully this word world will get back to normal at some point. Take care. Thank you for your session and thank you for your presentations.